Okay, greetings to you guys, and I'm here to ponder on the consolidated statement of financial position with goodwill. You see, most of the times, goodwill is a problem for many students, but here I will simplify the goodwill so that you understand it very perfectly. Goodwill is the most simple aspect of the consolidated statement of financial position. So here I'll do the workings. So the theory aspect, you have to go through the theory aspect. Okay. So now our consolidated statement of financial position. We prepare this where when one entity purchases more than 50% shares of another entity. That's all. Any consolidation question you see, they will tell you that A or B purchased 50% or A or B purchased 60% of C. So 50%, more than 50%, not 50%, more than 50%. So the purchasing entity, the one buying that number of percentage, is the parent. So the parent has more or greater percentage. So the one with the less is called the subsidiary. So in consolidation, it is parent and subsidiary. The one that purchased or the one with the more uh, shares is parent, and the one with the less is subsidiary. So you just you have to know this principle. Now, in solving consolidated statement of financial position, we have about five workings that you have to set up to make your work easy, irrespective of the question or the information. You have to set up those workings in order to make everything easier for you. So there's a question here I'll solve, but let me go through those five workings. The first working the first working the first working is to find the parent and subsidiary, to find who is buying more and who is having less of the percentages. So the first working is, so let's say A purchased 56% of B. So your first working is A parent, A parent, B sub. Your first working is to identify the parent and the subsidiary to make your workings very easy. Now the working 2 entails a lot. So your second working is to find the net asset of the subsidiary, because they are purchasing the company as a whole, including their assets and their liabilities. They are purchasing everything. So you have to also find the net asset, not of the parent but of the subsidiary, which is B over here. Not of the parent but the net asset of the subsidiary. So in that working, everything pertaining to the subsidiary will find its way there. Nothing concerning the parent will be there. Nothing. So the second working is net asset of sub. That's the second working. Net asset of sub. The first and foremost is the capital. The capital of the sub subsidiary. So when you set up your workings, this is net asset of the subsidiary. You come here and you write at acquisition. So at acquisition. At reporting. Post acquisition. Set up your workings like this. So the capital of the subsidiary. So you go to the financial statement and you look for it. So you bring the figure here at reporting, because the share capital of the subsidiary will be the same as the share capital of the reporting. So post acquisition is the reporting minus the acquisition, which will give you 0. To give you 0, that's the capital of the subsidiary. Now we have premium. So you are looking at the equity section. So if there's premium, you also bring it here. Acquisition, reporting, you subtract, the difference will come here. Now we have revaluation surplus, all under the equity section. So revaluation surplus, but in some questions you are not going to get this, so you just skip. But I'm giving you the full detailed calculation for the net assets of the subsidiary, right? So revaluation surplus, you subtract and you bring your answer here. Now we have retained earnings. This retained earnings confuse a lot of students. Retained earnings at acquisition, most of the cases, the retained earnings at acquisition is in the footnote. So they will be explaining and they will tell you that retained earnings at acquisition is blah 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 blah. So you bring the retained earnings at acquisition here. But in some cases, retained earnings at acquisition is in the financial statement. In the sense that when they give you the financial statement, under the equity section, they will give you retained earnings. And it will give you retained earnings at 1st January 20x5. They won't give you any retained earnings in the footnote. But in the financial statement, you see something like this: retained earnings and retained earnings at 1st January 20x5. This retained earnings at 1st January x5 will always correspond to the date that they purchased. Maybe they will tell you that on 1st January 20x5 A purchased 56% of B, and they are telling you that retained earnings at 1st January 20x5 is also this amount, meaning that retained earnings at acquisition is this. So anytime you read the footnote that you don't find retained earnings at acquisition, go to the financial statement, read through the financial statement. You will see two types of retained earnings. The one with the date, which is the same as the date of acquisition, is the retained earnings at acquisition. You bring your retained earnings at reporting. It is always in the financial statement. You less it. So let me bring the minus sign here. So at acquisition minus, okay. So it is the reporting minus the acquisition, which will give you the post acquisition. Now we have our fair value adjustments. This one, it will always be available to you. Fair value. The first footnote, they will tell you that asset with a balance of blah 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 had an amount of blah 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 more than. So fair value adjustment, we have your plant. Any footnote that pertains to fair value adjustment will come here. You have your depreciation. Anytime there's a fair value adjustment, depreciation must also be adjusted for. Okay, you have your machine also. So the fair value adjustment at acquisition, this was the figure. At reporting, it's supposed to be a negative figure. So it's supposed to be a negative figure. As reporting, depreciation at acquisition will be 0. Depreciation is always charged at the end of the year. So at reporting, which is the year end, it will be positive, not negative. Why? Because the fair value adjustment of the plant upwards was negative. So the corresponding entry is supposed to be positive. So in the case where the plant here is positive, the depreciation here will be negative. That's the principle. You bring your fair value adjustment, machine, year end will be 0, depending on the footnote. Now we have PEP. PEP is provision for unrealized profit, but in this case we are dealing with the net asset of the subsidiary. So PEP, provision for unrealized profit, when the subsidiary is selling. When the subsidiary is selling to the principal, it becomes a negative at the reporting. That's all. That's all you need to know about it. Now, what you will do is that you sum everything here. You sum everything here. Then you sum everything here. Then you subtract it to get what is here. That's all for the working 2. Now, the third workings, which happens to be a problem for students. Goodwill. That's the third workings, goodwill. And goodwill is calculated in this way. So goodwill, you pick the cost of investment. The question will give it to you, or it's even in the financial statement. So cost of investment. So the cost of investment, we have different type of investing in a company. They may give you, if the examiner is good, they may give you cash. You bring the figure here. Or they may give you share exchange. I will ponder on that. Share exchange. The figure is supposed to be here. Or they will give you deferred consideration. Deferred consideration. I will ponder on that. It will also be here. Then you add it. You add it. So in some cases they will give you only cash and share exchange. In some cases they will give you only one. So the total, you bring them here. Okay, that's where the total is supposed to be. That's where the total is supposed to be. Now, the next thing you do is that you bring your non-controlling interest. Non-controlling interest. The non-controlling interest at acquisition. At acquisition, it is always also in the footnote. They will give you the figure, but in sometimes they won't give you the figure, so you have to find for the non-contributing, non-controlling interest. This non-controlling interest is the lower rate or the lower percentage. the controlling interest is the parent that acquired. That's the controlling interest. So the remaining that is for the subsidiary is the non-controlling interest. So they may tell you that non-controlling interest is based on the shares or something around that area. So what you will do is to multiply the non-controlling interest, which is the lower percentage, by the shares. So in this case, we purchased 56%. We purchased 56%. So our non-controlling interest is 44%. So you multiply the 44% by the shares and bring it here. Or it is in the question. So non-controlling interest will come here. Now what you will do, meaning that, so this is what cost the parent. This is what cost the parent. That's the cash they invested, the share exchange, and the non-controlling interest of the subsidiary. That is the total cost of the parent. So our next working is that you less net asset of subsidiary at acquisition. At acquisition, the net asset, so you less net asset of sub at acquisition, not at reporting, because goodwill is calculated at acquisition on the day that we purchased the company. So our net asset at acquisition is the figure here, the sum of everything here. Remember our net asset workings. So the sum of everything here will come here as a minus figure. That is less net asset of the subsidiary at acquisition. So you less it to get your goodwill. So the figure you get is your goodwill at acquisition. So if you miss the step of calculating the net asset of the subsidiary at acquisition, you get it wrong. So you have to know how to calculate for the net asset of the subsidiary at acquisition. Then you less it from the cost of investment, that is the cash, and the non-controlling interest at acquisition. You less it to get your goodwill. And if there is any impairment of goodwill, you won't calculate for any impairment. They will give it to you in the question that goodwill was impaired by this amount, goodwill was impaired by that amount. So you less it, and then you get your final goodwill, which will find its way in the financial statement. That's all. That's all you need to know about goodwill. That's all you need to know about goodwill. The question we are about to solve have an iota or have something about share exchange. So I will do that. But with the deferred consideration, it means that they won't receive or pay the cash now. Maybe they will tell them that we will pay in 5 years time. That's what they will tell you, that maybe we will pay in 5 years time. But we are preparing the consolidation now. So meaning that you have to discount the 5 years figure to the present value. So maybe they will tell you that we will pay 5,000 in 5 years time at a rate of 5%. So you have to discount it, and in discounting it, you have to find your discount factor. So find your discount factor is equal to, bracket open, one plus the rate, which is 5%, bracket close, exponent negative the number of years. Now we are paying it in how many years from now? 5 years. Exponent 5. You press your enter. So this is your discount factor. So discounting it in today's term will be equal to the 5,000 you have to pay in 5 years time, multiplying the discount factor. So in today, I'm going to pay 3,917. So this 3,917 will be the deferred consideration. So this will be the deferred consideration. We have discounted it into present day terms. And in the share exchange, they will tell you that there's a question. The question entails a share exchange. Is you exchanging your shares. Your shares must probably have a higher value than the subsidiary. So you exchanging your shares. With the working one, they will tell you that they purchased 56% of B. But in some cases, they will tell you that A purchased 20,000 shares from B. B shares is 35,000. They won't give you the percentage, so you have to find the percent. You have to find how much A owns B. So by how much A owns B, A purchased 20,000. A purchased 20,000 from B, while B is having 35,000. So in finding how much percentage A is owing is equal to the 20,000 he purchased out of the 35,000 multiplied by 100. Multiply by 100. 56%. That's all. 56%. So they can give it to you in this form, or they will just give you the percentage straightforward. So you get your third workings for the goodwill, then your fourth and your fifth workings, which is not all that important, but I will still work on that for you. Your working four will be the non-controlling interest that will be found in the final financial statement. So your non-controlling interest, so it will be the non-controlling interest at acquisition, as in working 3. And here is it, the non-controlling interest at acquisition. So when calculating for the non-controlling interest to be in the financial statement, the first one is the non-controlling interest in the question, that is at acquisition. Now we have your non-controlling interest share of post-acquisition reserves, which is very simple. The post-acquisition reserves is actually, you see this total here, that's the working 2, calculating for the net asset of the subsidiary. These are the reserves. So the post-acquisition reserves are shown here, post-acquisition. So this one, the reporting minus the acquisition. Are you getting me? So let's say we had 25. Let's say we have 25,000. And we have here 36,000. The difference is 11,000. That is the reporting minus the acquisition. So this is the post-acquisition reserves. And you find the non-controlling interest here. The non-controlling interest is 44. 56 is higher, so the non-controlling interest is 44. So the figure that will be here non-controlling interest share of post-acquisition reserves will be the 44%. That's the non-controlling interest percentage. Multiplying this one, the post-acquisition reserves, that's your figure. Now, what you do is that you less any impairment. So, NCI share of impairment. The question will give it to you. If it's not in the question, you put 0 there. Your last workings, working 5, is your group retained earnings. Retained earnings. Your group retained earnings. And your group retained earnings is P retained earnings. That's the parent retained earnings. So all the, that's 100%. All the retained earnings of the principal will come here. So let's say 25,000. All the retained earnings of the principal. Now we have P's percentage. P percentage of S post acquisition retained earnings. Very simple. This here means that P's percentage of S, that's the principal's percentage of subsidiaries post acquisition retained earnings. We did it in working 2. When you come to working 2, the retained earnings is here. So post acquisition retained earnings is this one. So let's say we had retained earnings of 2,500, and here we have retained earnings of 3,500. The post acquisition retained earnings is the 3,500 minus the 2,500, and they are telling you that P's percentage. So P's percentage is 56%. That's the parent. So 56% of the 1,000 will give you the group retained earnings. P's percentage of subsidiaries post acquisition. So P's percentage. So P is having 56%. Multiplying the post acquisition retained earnings, which is over here, 560. Now we have you less P's share of impairment. P share of impairment is the same as the impairment over here in working 3, impairment in the question. So they tell that impairment was this at acquisition, it will be here. So let's say 3,000. So now you have to find your total. So this becomes your group retained earnings, which will go to the financial statement, which will become your non-controlling interest. The non-controlling interest will be at the equity section in the financial statement. Group retained earnings will also be equity. Goodwill, final goodwill will be under non-current asset. That's all. Your investment will also be under non-current assets, but it won't show in the consolidated statement of financial position. So that's the 5 major workings you need to do when you are doing your consolidated statement of financial position. When you are doing your consolidated statement of financial position, we also have something called negative goodwill. You see, our goodwill we had was positive. You're supposed to, normally it's positive. When you get negative goodwill, it's a gain, meaning that when you get a positive goodwill, it means that your cost of investment was more than the net asset of the subsidiary. But in the case where your cost of investment was lesser than your net asset of the subsidiary, it means that there was a good bargain. So the goodwill will be negative. It doesn't matter. Okay, but normally and in most cases, goodwill, your cost of investment must be greater than the net asset. The cost of investment must be greater than what you are buying. So the final or the difference won't be profit, it will be goodwill. Now let's go to the question over here. I don't think I will have time to read the question because time is far gone. Time is far gone. Now, this is a Kaplan question. Okay, this is a Kaplan question, and I will just use some 30 minutes to solve it. We have Premier and Sanford. In exams, they don't want to make things difficult for you. So what they will do is that the first letter of their names shows their position. You see Premier, first letter is P, so that's the parent. Sanford, first letter is S, subsidiary. Or normally the parent financial statement comes before the subsidiary. So you see Premier first and the Sanford second, right? So we have to start working. The question is saying what? Prepare the consolidated statement of financial position for Premier as at 30th September 20x0. 30th September 20x0. So the first thing first, set up your workings. Set up your workings. You can choose to read the questions before, but time constraint. So you set up your workings. So working one, per this one, you have to first find the parent and the subsidiary. And the question is saying that Premier acquired 80% of the equity share capital of Sanford. So Premier is parent with 80% shares. Sanford is sub with 20%. All as at you bring the date. The date is saying 1st June 20x0. So as at this time he purchased, so as at this time Sanford was now holding 20% and Premier was the parent. Working one, they give you half mark. Working two is your net asset of the subsidiary. So at acquisition, reporting, post acquisition, right? And the first thing first is your share capital. And in this case, your share capital will always be in the financial statement. Under equity and liability, we have equity share capital. Please, the equity share capital is not supposed to be 12,000. 12,000 is for Premier. The 12,000 is for Premier, which is the parent. But here we are saying that net asset of subsidiary. So if you bring 12,000, which is for the parent, you deserve some lashes. So you have to bring the 5,000 here, which is for Sanford. So at acquisition, 5,000. At reporting, 5,000. Post acquisition, reporting minus acquisition 0. That's all. Now we have our retained earnings. Retained earnings. Because looking at the question, you first pick information from here. So we are done with our equity shares. We have our other equity reserve, which they are giving us the note, and we have our retained earnings. So let's go to our other equity reserve with note IV. Note IV. Previous investment includes investment in shares which at the date of acquisition were classified as fair value through other comprehensive income. The investment have increased in value by 300,000 during the year. The other equity reserve relate to investment and is based on their value at 30th September 2009. There are no acquisition or disposal of these investments during the year ended. So it has nothing, the 300 has nothing to do with the net asset of the subsidiary. This investment relate to premier. This investment. So when you look at the financial statement, you see that other equity and reserve, there is 500 here and there is a nil here. That is 0. This is the financial statement of the subsidiary and this is the parent. The subsidiary is having 0 of this other equity, meaning that this is for the parent. It's the parent's business. So the next item under the equity and liability is the retained earnings. And the retained earnings, first you have to read the question. You have to read the question to find the retained earnings. Now, so I've gone through the question. There's no information on retained earnings. There's no information on retained earnings. There's no information on retained earnings. So what I told you in the previous or at the start of the lectures, when you read the question, there's nothing like retained earnings. So I told you to come to the financial statement. And when we come to the financial statement, most of the time when they give you retained earnings, they will give you retained earnings at 1st June 20x0. So retained earnings at 1st June 20x0 is equal to the date of acquisition. So in this case, they didn't give us any retained earnings at acquisition in the financial statement, but we still need retained earnings at acquisition to get our net asset of the subsidiary. We need retained earnings at acquisition to get the net asset of the subsidiary. So we go back to the financial statement, and going back to the financial statement, retained earnings here is retained earnings at reporting because there's no date attached. The date attached to this is the reporting, which is 30th September 20x0. So retained earnings at reporting is 4,500 for the subsidiary. This is for the parent. There's no way this will become retained earnings at acquisition. This is for the parent. So this 4,500 is retained earnings of the subsidiary at reporting. So you come to your workings of the net asset of the subsidiary. Reporting is the figure here, the 4,500. Now it is up to us to find the retained earnings at acquisition. It is very simple. If they don't give you retained earnings at acquisition, they will give you profit. So we have to look for our profit. And in the question, they told us that Stanford's profit for the year, the subsidiary's profit for the year ended was 3.9 million. That is 3,900. Wow. So there's profit. And remember that profit is what is taken to retained earnings. Profit. Profit is some way the same as retained earnings. So if they're going to give you retained earnings at acquisition in the question, and if you don't find it in the financial statement, there is always going to be a profit figure in the financial statement or in the footnote. At times the profit figure is in the profit and loss, but in this case the profit figure is in the footnote. So what you will do now is that retain earnings at acquisition. So now your retained earnings at acquisition will be equal to the retained earnings at reporting minus the profit, which was 3,900,000, meaning that 3,900. That is your retained earnings at acquisition. But it is wrong. Do you know why it is wrong? Because the question is saying that he purchased or acquired Premier on 1st June 20x0 and the financial statement is on 30th September 20x0. So what you need to do is to prorate that figure. So from June to September is never 1 year. So June, July, August, September, that is 4 months. So you have to prorate it to 4 months. So 4/12. That should be your retained earnings at acquisition. So your retained earnings will be your retained earnings at reporting. That will be in the financial statement. Retained earnings at reporting. So 4,500 minus profit for the year. So less profit for the year. But in this case, the profit for the year was 3,900. 3,900, but it was for 4 months. So times 4 divided by 12. So the figure is the 3,900 multiplying 4/12, 1,300. So the retained earnings at acquisition will be the retained earnings at reporting 4,500 minus the profit for the year 3,200. 3,200. That's all. So retained earnings at acquisition is retained earnings at reporting minus profit for the year. So the profit for the year is prorated. So post acquisition reporting minus acquisition 1,300. Now what we need to do is to go back to the footnote, because we have exhausted the equity of the subsidiary. We have exhausted it. So now let's go to the footnote. The footnote said that at the date of acquisition, the fair values of Sanford assets were equal to their carrying amount with the exception of its property. This had a fair value of 1.2 million below the carrying amount. Property fair value adjustment. And the question is saying that they were all equal except that the property had $1.2 million below its carrying amount. Below, meaning that it's a deficit. Below the deficit. So it's supposed to be a negative figure, 1,200. In some cases, they will tell you that it was 1,200 above. If it's above, you are good to go, it's positive. But if it's below, it's supposed to be negative. So at reporting, we are going to get the same figure of negative 1,200. So reporting minus your acquisition, 0. How do we do next? We do our depreciation. They tell you that below its carrying amount and had a remaining useful life of 8 years at the date of acquisition. Sanford has not incorporated this in its financial statement. So it had a remaining useful life of 8 years. Remaining useful life of 8 good years. So what you will do is to calculate for the depreciation. So the depreciation is probably straight line. So the depreciation is that the carrying value is 1,200. That's 1.2 million. The years is 8. So the depreciation per year is 1,200 divided by the 8, which is 150. But when you bring the 150 in the workings, you are wrong, because they purchased the company on 1st June and you are reporting on September, 4 months. So you prorate it. That's 4 over 12. 4 months over 12 months in a year. So you then multiply them to get your 50. So this figure will be your depreciation figure here. And as I said in the earlier times of the lectures, up here is negative, so down here is supposed to be positive. But depreciation is recorded at reporting, not at acquisition. At acquisition, you don't record depreciation, so depreciation will be 50 positive over here. This minus this 50. Let's read the question again. The question is saying that Premier had 2 million at cost to Premier of inventory that had been supplied in the post-acquisition period by Sanford. As at 30th September, Sanford made a markup on cost of 25% on these sales. So in this case, the subsidiary sold to the parent. And here, I said it in the workings that in working 2, when the subsidiary sell to the parent, it will find itself here at the reporting. It will find itself here, because we are calculating for the total net asset of the subsidiary, right? So you come here, you bring your PEP, provision for unrealized profit, and it will always be 0 at the acquisition and a figure at the reporting. Now the unrealized profit, they told us that at cost, meaning that Premier had 2 million at cost to Premier, meaning that he bought it for 2 million, meaning that the subsidiary also sold it for 2 million. So meaning that the subsidiary sold goods to the Premier at a profit, and we are a group, so we are not supposed to make profit within ourselves. So we have to take the profit out of the 2 million we sold. So our 2,000, and the markup was 25% on sales. I'm not here to teach you markup and margin. You have to know. So in this case, it was a markup on sales, and anytime it is a markup on sale, what you do is that the rate will come up That's 25. Then you divide it, or what will come next is 100 plus the rate. So in this case, it will be 125. So equal to this 25 divided by the 125. So when you multiply this by the 2,000 or the 2 million he sold, you get 400. This 400 is the profit on the cost. So this profit of 400 will be the provision for unrealized profit, which is supposed to be a negative figure at the reporting session. So negative 400. That's all. Then you add them. Have to add them. So that's your total. Now you do your work in 3. Goodwill. Goodwill. Now Goodwill, they told us in the question, Goodwill, the information is always above. Information is always above. On 1st June, he purchased 80% of the equity shares of Sanford. So the first thing he purchased was the equity shares of Sanford. The consideration consisted of 2 elements: a share exchange of 3 shares in premium for every 5 shares acquired in Sanford, and 800,000 cash. And 800,000 cash. Let's bring our cash so that you don't get confused. Now, share exchange. Share exchange. Now the share exchange is that a share exchange of 3 shares in premium for every 5 shares acquired in Sanford. So meaning that the total number of shares he acquired in Sanford is what you are looking for, not the total shares of the principal or the total shares of the subsidiary. So you are not looking at this. You are not looking at the 12,000 or the 5,000, but you are looking at how much he purchased from the subsidiary. So out of the 5,000 here, how much he purchased from the 5,000 over here. And they are telling you that in some cases they will give you a percentage that he purchased this percent out of. But in this case, he said that a share exchange of 3 shares in premium for every 5 shares. So 3 for 5, meaning that 3 upwards, 5 downwards. 3 for 5. So 3 over 5. So that's 0.6. 0.6. Always when they tell you that 3 for 5 or this for this, the first figure will be the numerator, the second figure will be the denominator. So he purchased a share exchange of 3 shares in premium for every 5 shares acquired in Sanford. So 3 over 5, which is 0.6. That's the 3 over 5. Now you multiply it by the total number of shares of Sanford, the subsidiary, 5,000, to get your 3,000. To get your 3,000. Now what you will do, so this is the total number of shares, but here you are dealing with the value. So when you continue, they will tell you that the share has not been issued, has not yet been recorded by Premier. At the date of acquisition, shares in Premier had a market value of $5 each. So the 3,000 multiplying the 5, they will always give you the rate, the market value. So you have gotten your 15,000. That's all you need to know about the share exchange. Now, per the formula I gave you in the earlier lectures, we also have our non-controlling interest at acquisition. Non-controlling at acquisition. When you read the question here says that Premier's policy is to value non-controlling interest at fair value at the date of acquisition, deemed to be 3,500,000. So 3,500. 3,500. So when you add them, this becomes your figure. Now you less net asset of sub, which will automatically be this. You're working 2. We had 7,000. We had 7,000. Now this minus this will give you goodwill. But reading the question say that what? Consolidated goodwill was impaired by 1.5 million. Impairment. So impairment 1,500. So your total goodwill is this minus the impairment. That's 10,800. 10,800. Your 12,000. Your 800. Okay. Yeah. So in our share exchange, we are supposed to multiply it by the parent holding. So your 3 for 5, your 3 over 5, which is 0.6, multiplying the 5,000. That's the subsidiaries shares. Multiplying the market value, which they gave it to us as 5. Now he purchased 80%. So 80%, this multiplying 80% is 12,000. So you get your net goodwill over here. Your net goodwill. Now you bring your working for. Working for. Your working for is your non-controlling interest. So now we have your non-controlling interest at acquisition. And here is it. And it's even in the question, in the footnote. So this one. Now you bring your non-controlling interest share of the post-acquisition reserve, as I said earlier on. And the non-controlling interest of the post-acquisition reserve, this is the post-acquisition reserve. That's the working 2, the net asset of the subsidiary. The net asset of the subsidiary. So this acquisition reporting. So the post-acquisition reserve is 950. And I'm saying that they say that non-controlling interest share the non-controlling interest. You are looking for non-controlling interest. So the non-controlling interest share of post-acquisition reserves. So the NCI here, he purchased 80%. So the NCI, non-controlling interest, is 20%. So 20% of 950 will be here. 190. Now we have your NCI share of impairment. Impairment at acquisition was 1,500. NCI is 20%. So this 1,500 multiplying 20%. So this is supposed to be a negative figure. So this is your total figure, 3390. Now we have your working 5, your final workings. That is group retained earnings. Group retained earnings. The first thing is that you bring P, that's premium or the principal retained earnings at reporting. Go to your financial statement. At reporting, 12,300. So 12,300. Now what you do is that share of Sanford post acquisition reserves. So as I said earlier on, post acquisition reserve. So this will be, that is the P's share, that's premium share, so 80%. And the post acquisition reserve was 950, that's 760. Now we have P's, that's the principal share of impairment. Principal 80%, impairment 1,500, impairment negative, that's the total. So that's all. So the NCI is always NCI, and the group retained earnings, you take P's retained earnings, P's, so the post acquisition. So the working 2 is the most important aspect. So this one, when you are looking for your NCI to be recorded in the financial statement, it is 20% of this. Group retained earnings is 80% of this. So this goodwill, this figure will be under the non-current asset. This figure, non-current asset. NCI, the NCI will be under the equity. Group retained earnings will also be under the equity. So this is the workings. This is the workings. So what we need to do when solving for consolidation is now the principal plus the subsidiary. So consolidation is just this plus this. Are you getting me? So but in this case, looking at the footnote, there was a fair value adjustment. There was a fair value, and they said that the carrying value was 1.2 million below. So it's a negative figure. So what happened here? What happened here in working 2 is what will come here. So we have this plus this minus the undervalue of 1,200 plus our depreciation of 50. So this is our figure for the non-current asset. Investment will be this 1,800 plus 800 consideration, the cash he paid, this 800 minus, when you read the question says that there was an investment here of 300,000. The investment have increased in value by 300,000. So this 300 will also come here plus the 300. That's 1,800 plus 300 plus 800. That's 2,900. 1,800 minus the 800 we paid plus the 300 increase in investment, 1,300. Now you bring your goodwill. This is your goodwill figure. Then you proceed with your current assets and your current liabilities. I will end the lecture here and continue some other time. Thank you very much. Subscribe to my channel. Have a nice day.